Hey, this is David Frasz from Lumen. If you want to learn how to use your small axe to build an empire, you should be listening to Small Axe Podcast with my good friend Nico.
Hey, guys, this is your boy Nico, your host of the Small Axe Podcast. Hey, this show is dedicated to helping you become the best multifamily real estate investor that you can be. Now, whether you want to be an active or a passive investor, this show will give you all the resources you need to help sharpen your axe and build your own personal empire. So you know what? Sit back and relax and enjoy this show. And hey, if you find value in it, I would love for you to subscribe, leave a 5-star rating, and write a review. I love you guys. All right. Hey, Small Axe community. It is your boy Nico here. And today I'm hanging out with a really super cool dude, David Frasz. I met him a few years ago, and he is a direct lender. He originates loans, and you're going to find out a lot more about that today. I'm really excited to get him on now. But first, let's start with his bio. David Frasz is a director and commercial loan originator for a top nationwide CRE lender. He's responsible for relationship management and originating commercial loans across all asset types with a specialty in direct originations of multifamily financing, including Fannie Mae, Freddie Mac, FHA, HUD, and bridge loans. David is acutely focused on building strong relationships with clients and helping them achieve their investment goals with a white glove financing experience. With nearly a decade of experience in multifamily finance, David has built a reputation for client service and for his track record, which demonstrates his ability to close even the most difficult loan transactions, even those that competitors and counterparts suggest are impossible. David's skills were sharpened in his early career role as an underwriter, where he underwrote more than $1 billion in closed loans and oversaw the underwriting of more than $9 billion in transaction screening volume. Prior to real estate, David held various positions at State Street and JP Morgan after he graduated magna cum laude with a BA in managerial economics from Union College in Schenectady, New York. All right, so without further ado, I'm going to get this guy on. Welcome to the show, David.
Hey, Nico. How's it going?
Good, man. And, I went kind of high level over your bio. Maybe you can kind of share a little bit more of your journey and let us know how you got to where you are today.
Yeah, I appreciate it. Thanks for having me on. And I been in real estate now for about a decade and started out of school. In school, I knew I wanted to get into finance. I was thinking I wanted to do something with investments, but didn't really know what, didn't really have any formal training, went to a liberal arts school, so didn't have any very specific degree that I could just plug and play into a certain role or occupation. So I kind of bounced around in some finance roles early on out of school and found myself kind of not feeling like I had any direction or anything that I could really throw my energy and my kind of momentum behind to really push myself to where I wanted to be, which ultimately was doing something that I enjoyed, that I found interesting and that I could be passionate about and really throw myself into, because that's kind of always been who I am. And so I really had to think deep, and I did a lot of networking and a lot of cold calls and setting up meetings with complete strangers in finance. And then I found myself interviewing for an investment consulting role where I had to do a case study about comparing and contrasting one or two of a couple of different investment firms. And the two I chose were real estate. And after that case study, all I really wanted to do was get into real estate. And a few weeks later, I had networked myself into a job underwriting, and kind of the rest is history. Really just everything you read in my bio since then has just been kind of deals, transactions, networking, and becoming an expert and trying to understand everything I can about multifamily and build as many relationships as I can in the industry.
Awesome, David. Thank you for sharing, man. Yeah, I didn't know that about you. I appreciate you sharing that. Now, let's jump into a little bit more of in-depth conversation regarding debt, because it's such a huge topic right now, and I think it is timely that we have you on. I'm excited to be speaking with you, and I'm going to be picking your brain a little bit. First of all, let's start with, in your bio, it says you're a direct lender. What is that?
Yeah, so we actually put out the money. So if you do a loan with us, we're actually the ones funding the loan. There are a lot of brokers out there that call themselves lenders, and they're really brokers, which has their own kind of niche in the real estate space and the debt space. But when you do a loan with us, it's actually originated on our note, and it will have all of our loan terms and everything. So we are the lender. So when you hear direct lender, that means you're dealing directly with the lender and not an intermediary or a broker, as sometimes they'll refer to themselves. And there are a lot of those out there. There are a lot of brokers. There are a lot of intermediaries, and particularly with Fannie Mae and Freddie Mac, there's always a direct lender in there, whether you're working directly with them or you're working through an intermediary or other consultant.
So you work with Fannie and Freddie, or you originate loans for Fannie and Freddie, or is it for Lumint?
That's right. So I work for Lument, and that's the lender. So I'm an originator for Lument, and that just means that they're my employer. So I work directly with them. Fannie and Freddie are actually, you view them as investors or loan guarantors in the kind of back end securitization process on the loan. So we underwrite the loans in accordance with those standards that Fannie Mae and Freddie Mac or HUD have put out there. And by doing that, they essentially guarantee that the note will get that we can close the loan, and then they'll purchase the loan from us. So that's a way to do it other than carrying loans on our balance sheet, which might be, a bridge loan or construction loan or some other type of loan that, banks are often your typical balance sheet lenders.
Gotcha. So you do that as well. And this is different. I just kind of want to clarify for people some people are looking for community bank loans, which is different. Is that correct?
Very different. Yeah.
All right. So maybe you can talk a little bit more. So our focus for today is not going to be bank loans. We're going to be talking more about the Fannie and Freddie / agency. What does agency mean?
Yeah. So the agencies, the most common agencies that you hear when we're talking about agency finance is Fannie Mae and Freddie Mac. HUD is kind of in a separate category, and that's, the FHA, kind of a separate loan product. So when we're talking about agency finance, we're typically talking about Fannie Mae and Freddie Mac. And they're basically big organizations in the debt space that are kind of tasked with propping up, in a sense, the commercial financing space in housing. So obviously Fannie and Freddie as well have residential lending groups, which is kind of your 1 to 4 unit owner occupied homes typically, or small investor, partially owner occupied homes. I focus on the commercial side, so that's 5 units or more. And really, what Fannie and Freddie do is they're given by the FHFA, they're given a certain allotment of capital that they're allowed to lend, essentially, or put out into the market in debt on multifamily properties every year. And as a direct lender, we originate those loans, and then they get sold to, Fannie Mae or Freddie Mac. And Fannie Mae loans can be also sold to other banks and other institutions, but they're guaranteed performance by Fannie Mae for the note buyer. Same thing, Freddie Mac. Their loans get actually put into large securitizations of billions worth of transactions and then sold in pieces as a securitization.
Cool, David. So you mentioned in there that there's a certain amount of money that they kind of want to place, is kind of how I heard that. Does that typically happen in the beginning of every fiscal year? Like, how does that work?
Yep, it's typically in line with the calendar year. It hasn't always been. There was one year, a few years back, where they had to make some decisions, and they gave us kind of like a 5-quarter number. So we had, over the next 5 quarters, we could use a certain amount of capital, but that was because they kind of re-upped the capital allotment towards the end of the year rather than at the start of the new year. But yeah, it's generally in line with the calendar year. And so you'll see different things from the borrower's perspective. You'll see different things that kind of you don't maybe understand, but certain times when maybe rates go down, but you don't see a corresponding drop in Fannie Mae or Freddie Mac rates. And that might have something to do with the fact that they're already very close to their volume limit. And so they don't necessarily want to be fighting for business at low rates because they know that they're going to reach the cap is how we call it. So they have to manage their volume and they like it to be kind of consistent marching towards that number throughout the year so that they don't have a big overflow at any particular time or a big, trough in volume at any particular time. And that's kind of what we're seeing right now a little bit with Freddie Mac, where at least on the small balance side, they dropped their rates in early February and there was a huge deluge of volume that they signed up. So they're kind of pumping the brakes and their rates have since come back up pretty dramatically in the last month.
Uh-huh. Makes sense. All right. Awesome. That clarifies a lot. So just to kind of recap for everybody, if they have money to place, right? If they are in need of placing money, they might, consider dropping rates to incentivize people to originate loans. If they are, have an abundance of people, writing loans, and they will kind of just keep the rates as is or keep them higher. Makes sense because they have a certain amount of capital to place. Now, David, what are we looking at? Like, what is SOFR or the 10-year treasury? Like, what is Fannie and Freddie looking at?
Yeah, so the typical benchmark index, as you might hear it referred to, that's used are the treasuries. So the 5-year, the 7-year, the 10-year treasury. Obviously, the 10 is the most common, but if you're doing a 5-year loan, it's going to be benchmarked on the 5-year, and same with the 7-year. But so those are the typical benchmarks in our space, in the Fannie Freddie space. Those are the typical benchmark rates. Other lenders use different benchmarks, such as the swaps, whether it's the 2-year swaps or 10-year swaps or whatever, that they'll use different indexes, and it just whatever they decide to use is kind of what they do. And then there'll be a spread over that kind of comprises your whole rate. So Fannie and Freddie were generally looking at the 5, 7, 10-year treasuries. If you're doing a bridge transaction, you're generally going to be looking at the SOFR rate, which the common one that we use is the term SOFR, so 30-day term SOFR, which is different. There are different SOFR terms, but that's often in the benchmark index that you'll see on at least one of our bridge loans and many other institutional bridge lenders. You may also see in the space of fixed rate bridge lending, you might see them do their rates over the 2-year swaps or something like that. In those instances, you might, if you're doing a fixed rate bridge that's a 2-year term, that might be why it's over the 2-year swap. For us, for a conventional institutional bridge loan, the rate might reset every 30 days. And so that's why the benchmark is sort of based on the 30-day SOFR. But they're just different benchmark indexes that are tracked that add some stability or some kind of thought process behind how one gets to a rate for a certain loan product.
Man, and it can get very, I know your job is to kind of clarify this for all of us and kind of guide us in the best route and the best direction for our properties and our needs and our business plan and all that. But before we get to that part of this, I kind of want to ask you about what is a good spread or a bad spread, like what you would be looking for in a spread, and does the spread change a lot?
Yeah, so the spread actually is then comprised of different things as well. So there's for loans that get securitized, say a Fannie Mae or a Freddie Mac loan, the spread is going to be comprised of not only the servicing amount, which is the amount that might go to the servicer like Lumen or any of our kind of competitors out there in the market that actually service their own loans after they close them. So that's this kind of the servicing portion. And then there's the investor portion, which is going to be kind of, if the loan's going to be sold to Wall Street, let's say Bank of America or Goldman Sachs or whoever might buy the note, there's a spread there that is basically their yield that they're expecting to get. And the way these loans trade on the secondary market is that they'll be, or I guess the initial rate lock, there'll be bidders, these Wall Street banks that might have their capital markets desk saying we'll buy this loan at a spread of 200 basis points or something like that, and that means 2% is what they want, what they expect on their yield, and they're not going to go below that to buy the loan. And that stuff changes daily because these guys are looking at their Bloomberg terminals with where the market is, where their book is, and they're often using agency mortgage-backed securities to fill in gaps in their portfolio that they've allocated to that, just like they would use treasuries or bonds or any other sort of instrument.
Okay, cool. And you mentioned in their rate locking, is that something that's feasible or possible? Do people rate lock? Does it cost money?
It generally, no, there's no actual cost of the rate lock. There's always going to be a deposit, which is kind of the borrower's commitment to closing the transaction. And the reason for that is that if a borrower agrees to close a transaction, signs the commitment, agrees to rate lock the deal, and then they back out, there are actually real costs to us as the lender for that broken rate lock. So once we've basically signed a contract, an agreement with a Wall Street firm to sell them a loan, we have to sell them a loan or we have to pay them fees for the broken rate lock. So that kind of, there's not really a cost to rate lock in most instances, but there is kind of a deposit that's required to kind of say we're committed to closing this loan. And then
Gotcha.
that generally comes back to the borrower at the settlement statement.
Gotcha. All right. I have so many questions and I'm not sure how to navigate them really, but I'm gonna just shoot some off. And if it's a little bit, fragmented, that's fine.
Sure.
So you mentioned in there Freddie small balance. What is that?
Yeah, so both Fannie Mae and Freddie Mac have their kind of conventional lending platforms, which are for Fannie Mae, it's loans that are $6 million or more. Freddie Mac, it's loans that are generally 7.5 million or more. And traditionally, they can go below those numbers. But now, years ago, it's not so recent anymore. But when each agency rolled out their small balance platform, it was kind of a different team and a different program with slightly different metrics that was designed to meet the need of small borrowers that were investing in apartment buildings that might need a loan of say 1 million to 7.5 million. And those limits have kind of changed over the years. Freddie Mac small balance used to be 1 to 5 million. Now it's 1 to 6 with kind of a bump to 7.5 in certain scenarios. So that's really just when someone says Freddie SBL, it just means it's a Freddie Mac loan, but it's run through the small balance program because of the loan size or the kind of profile of the deal.
Awesome, man. Thank you for clarifying. And are there different terms and rates for those small balance loans?
There are, yeah. It's particularly for Freddie Mac, the conventional program and the way the rate and the terms are structured is actually very different than on the small balance side than it is on the conventional side. But in general, the small balance programs for both Fannie and Freddie, you're generally going to see higher rates, and it doesn't always have to be significantly higher, but generally you're going to see higher rates for smaller loans, just like you might expect if you're doing, a $5 million loan versus a $20 million loan. Generally, there's going to be some benefit there to doing a larger chunk of business with any lender.
Yes. And consulting with you, let's say I had a certain deal under contract or getting close, and consulting with you, you would kind of guide me towards, hey, this would be better suited for, Fannie or Freddie or small balance or conventional. And you would kind of guide me through that. Is that right?
Yep. Yep. And we have all Fannie Mae and Freddie Mac licenses. So generally, part of the intake when you and I start talking about a specific deal, my mind has to be thinking about all the deal terms and the specifics of market size, occupancy, cash flow. I mean, everything to do with the deal, tenant makeup, all of that needs to be kind of understood by me in order to understand what the best loan options are. And then we have to size out those loan options to determine which one is going to be the best one for your particular deal and your particular scenario. Not all of our competitors, not all agency lenders have all of the licenses. So certain lenders may really guide you towards, say, Freddie Mac small balance, because that might be the only license that they have or one of the only licenses that they have. And other lenders may have kind of a minimum loan of, 5 million because they don't have small balance licenses. So they're going to try to guide every deal into the conventional bucket, which isn't necessarily ideal for the particular transaction that you might be contemplating.
Yeah, awesome. I love it. And you also mentioned in there that the market matters. Can you just talk a little bit about it? I know it's very broad and it can be a little confusing to really to clarify, but maybe you can kind of talk broadly about the different markets.
Yeah, so there are different ways to tier markets. Obviously, some banks will have markets that are, they call them in footprint, out of footprint, or other lenders will use primary, secondary kind of ways to tier, and whether those based on population or just major cities or something like that, it can vary. Fannie Mae and Freddie Mac also tier their markets differently from other lenders, but also differently from each other. Fannie Mae has a essentially a kind of like a 3 or 4 tier. They have different tiers for different markets. They have strong markets. They have what they call eligible markets, which are kind of your standard markets with some nuances that kind of allow them to be treated a little bit more like stronger markets. And then they've got your standard markets, which is the majority of markets around the country are going to be kind of your standard Fannie Mae markets. And then they've got what they call pre-review markets or tier 3 markets. And those are going to be markets that for one reason or another, Fannie Mae has decided that they want to be able to pre-review those transactions because there's some level of elevated risk, or maybe they just have an elevated level of exposure to that market on their current book. And so they want to make sure that they know in advance what sort of deals, what profile of deals, and how they're underwritten that are coming into the portfolio in that market. And then beyond that, there's kind of an additional level of pre-review market where even if the lender reduces the leverage on the property, they still need to be the deal still needs to be reviewed by Fannie Mae. Whereas your kind of your standard pre-review market, if the lender reduces the leverage to 65% LTV or even 55% LTV and 135 debt service coverage or 155 debt service coverage, we can still delegate. We're still delegated to just close the loan and then send it to Fannie Mae. But this final tier is a tier of markets where Fannie Mae wants to review it no matter what the leverage is. Freddie Mac, on the other hand, they'll tier their markets a little bit differently, particularly in the small balance space. They have kind of your top markets, your standard markets, and then your very small and your small markets. And each of those different markets, as you kind of move down from your top market all the way to your very small market, is going to have slightly more restrictive LTV and slightly more restrictive debt service coverage ratio, slightly less guaranteed or delegated IO. And your rate's going to be slightly higher in those markets. So that's all a way that Freddie Mac kind of adjusts for the size of the market. And Freddie Mac uses kind of a population kind of at the county level. So these markets are typically based on size, very small, standard. And then your strong markets are going to be like your New York, your LA, Miami, Dallas, Fort Worth, Washington, D.C. It's kind of your big cities. Those are going to be kind of your strong markets in the Freddie Mac small balance program.
Awesome.
So markets get tiered very, very different across different lending platforms.
I didn't know that, man. I thought that there was one standard way that the markets were tiered and that was it, and then everybody followed those guidelines, but I guess not. And it makes sense. If I'm giving out money, I kind of want to know what fits my criteria, right? So I get it. That's awesome, man.
I will say one challenge, particularly for someone like yourself, if you're investing in, a few different places around the country and you've got a deal that you look at in one particular town, one county, you might work with me and it might be a standard market. You might look at a deal in the next town over and it might be in a different county And without even knowing it, even though it may be 5, 10 miles away, it could be in a completely different market tier. And so instead of getting 80% LTV or 75% LTV, you might only get 75 or 70, even though the deal is basically the same, meaning the property and the numbers and the size and things like that. But just because of the market, it might be slightly different terms that you might get.
Awesome. Interesting. And you mentioned DSCR and LTV. Is the LTV solely driven by the DSCR requirement?
So there are two separate sizing metrics that kind of we have to basically, our loan has to be the lesser of. So we need a minimum debt service coverage of, whatever it is for a particular loan, particular market. Typical is 1.25. So that, let's say that's the minimum debt service coverage. We also can lend up to a maximum of, let's say, 80%. So if the debt service coverage is a 125 at a certain loan amount, but that loan amount would be 82% LTV, well, then the loan is going to get cut. So
Mm-hmm.
we'll go down to 80% LTV, and that might push the debt service coverage to a 127 or something like that.
Mm-hmm.
Similarly, though we might be able to lend up to 80% LTV, if we're only getting to 65 or 70% LTV loan, or 72 or 76, based on a 125 debt service coverage, then we have to cut the loan to that level.
Mm-hmm.
So it's a way that we ensure that we're not lending beyond a certain level of cash flow that can cover the actual debt service and the money that's required to pay principal and interest. And another way that we can prevent ourselves from lending on properties where the LTV, or the actually the value that's left in the property beyond our loan is smaller than 20%, say, on an 80% LTV loan. So we kind of limit our exposure from a leverage standpoint, but also limit the risk of the borrower not being able to make debt service if something comes up at the property for a period of couple of months, elevated vacancy, or reduced collections or something like that.
Awesome. Upon takeover and we begin managing a property, does that 1.25 debt service coverage ratio stay consistent? And do we need to meet that requirement throughout the year, or does that level change?
Generally not. There are levels at which, if your debt service coverage gets below a certain level based on your periodic submission of your financial statements, the loan may go on a watch list where our asset managers will pay a little bit closer attention to it, maybe have an inspection to just make sure everything looks okay. But there's no hard requirement that you have to keep the debt service coverage at a certain level. If you have vacancies or you do renovations or you have a fire or something like that, those are all understandable situations. Same thing with the LTV. We don't require that you keep the loan at 80% LTV. If the market cuts back or something, you don't have to contribute more capital to the loan. That's just kind of on the books just because the market value might have dipped, or you might have gotten a new appraisal that came in a little bit lower or something like that. So we want to make sure you're maintaining the property, and asset management is important, but things happen, and what we'll do is we'll just take a closer look from an asset management standpoint and kind of more closely monitor those properties if they fall below a certain level.
When you're doing your initial sizing for these properties, for these loans, do you like, how are you looking at deals? Because everybody's like, oh, this is people are looking at taking their in place T12, right? They're looking at everything in place, and then they're not really factoring in for the future growth of taxes or insurance. And I'm sure that you guys do when you're looking at these deals. Can you just talk a little bit about how that plays into your underwriting?
Yeah, so we do, and not all lenders do this. You'll see smaller, kind of what they call DSCR lenders that lend on, 1 to 4 unit properties, or they may have an 8 unit maximum, or a, $1 million maximum loan or something like that. Sometimes those lenders will just do kind of your taxes, your insurance, and your utilities or something like that. But we use full cash flow underwriting. So we're going to make sure we're properly underwriting your taxes, your insurance, your utilities, your repairs and maintenance and property level kind of contract services and trash, administrative expenses, payroll, management, all of that. We'll also apply a vacancy factor and will include a replacement reserve allocation in the cash flow underwriting. So some of those things are things that borrowers don't necessarily think about when they're underwriting a deal. They don't necessarily add in reserves, or if they're going to self-manage, they don't include a management fee, or if they're not going to have any on-site staff, they don't include any payroll in their underwriting. Or maybe it's a really tight market and they think we're not going to have any vacancy at all at the rents we're projecting. All of those things are things that would then lead to a discrepancy between what a borrower might think they can get for a loan and the loan that we can actually promise them or ultimately close on. So those are some of the big items. Honestly, taxes over the last several years has been a very big item. A lot of municipalities have been, with the growth in real estate values, a lot of municipalities have been reassessing properties much higher, and so taxes are going up. And some municipalities will increase your taxes based on the sale price, and some are non-disclosure, so they just kind of use comp approach in the area and have to make things kind of relatively fair and balanced throughout the taxing district. But it varies depending on the market that you're investing in. The big one right now, the biggest one, is insurance, where we've seen property insurance rates go up pretty much everywhere in the country. And certain markets, your insurance might be $200, $250 a unit per year. In other markets, it could be $1,000 or $1,500 or $2,000 a unit, like in kind of coastal areas in flood zones and that sort of thing. You could just see a massive dollar per unit for your insurance. And so one of the things that is important is kind of understanding the Fannie Freddie insurance requirements, or the insurance requirements of whichever lender you're going with, whether it's a bank or a non-bank lender or what have you, and making sure that you get those requirements in front of experienced insurance agent early enough in the process in your underwriting, so that you don't get yourself into a deal and find that your insurance cost is going to be double. And that could mean going from 5% of your income to 15% of your income or something like that. So you don't want to be surprised by that when you're 2 weeks away from trying to close a loan.
Yeah, wonderful advice. Awesome. All right. Now, so can you explain? I don't know if it's possible. Can you, but I'm going to try to get a little explanation of what the difference between defeasance and like prepayment is.
Yeah, so there are various methods of prepayment, and prepayment is kind of a new concept to a lot of investors that maybe have built a portfolio by buying, single family rentals or 1 to 4 unit rentals using residential financing. And they've kind of built a portfolio, and now they might be getting into commercial financing. But generally, all commercial financing is going to have some sort of prepayment penalty, at least in the stabilized space. And certainly with Fannie Mae and Freddie Mac, there's going to be some prepayment structure that prevents a borrower from just prepaying their loan anytime they feel like it without penalty. So there are prepayment structures like declining prepayment, which might be a 5-4-3-2-1 prepay structure, or a 3-2-1 prepayment structure, or something like that. And then there's going to be kind of your yield maintenance or your defeasance. And those are slightly different and they get pretty complicated. The thing to note is essentially that any prepayment penalty, if it's not a declining prepayment penalty, it's defeasance or yield maintenance, it's basically designed to ensure that the holder of the note, which could be Fannie Mae, could be Goldman Sachs, it could be anyone who's currently owns the yield on that note, it's to ensure that they get their yield that they paid for and that was agreed upon in loan agreement, in the contract of doing the loan. Because again, that loan has been sold. It's not just being held on the balance sheet. So it becomes an investment instrument. So when you prepay a loan, basically they stop getting their yield on a regular basis, and they need some sort of compensation on that. So in the case of yield maintenance, it might be essentially taking the present value of all future cash flows that can be expected on that note and running some capital markets calculations based on where the rate of the note is versus where rates are today and where they're projected to go and how long it's been since the loan was originated and how many months left to maturity, things like that. So it takes all that into account and determines here's the amount of prepayment. And that can be fairly significant if it's early in the loan term, if rates have maybe gone down or even stayed the same. That yield maintenance prepayment can be very significant. And for all intents and purposes, it can make it just pointless to do the loan, where you might actually lose money by trying to prepay the loan. Defeasance is similar, but essentially it's kind of like defeasance is common in Freddie Mac, where the loans are all pooled together in large tranches that are then sold. And so in order to actually pay that loan off, it's coming out of the security. It needs to be replaced with a note or some sort of instrument that then yields the same yield that that loan was yielding, because that loan is no more. So now there's a gap in the investment. If you think of it like a Rubik's Cube or something, if you take one of the little cubes out, you have to replace it with something else that is essentially yielding the same, so that the structure of the entire security is maintained. So they're very different, but they're all essentially designed to compensate the note holder if you prepay that loan.
Beautiful, man. I didn't even prep you for that. That was pretty intense. All right. Let's do this. I know we're getting really over time here, but I wanted to ask you just a statement of like, if you can share one of like a recent loan to give us an idea of what we can expect more or less. I know that there are different markets. Every deal is very different. I know that the loan that you provide is going to be different because we mentioned all these different types of loan: conventional, small balance, Fannie, Freddie, HUD. But give us a general idea of where, like maybe a deal recently that you had closed on, that so you can give our listeners some sort of idea of what to expect.
Yeah, it's a broad question. Again, it's market, it's sponsor, it's deal, asset quality, condition, cash flow, all of that. But I would say that the big thing right now is cash flow. Whereas in years past, you might have been able to buy a property with under market rents and still get a decent 75 to 80% loan. Today, that's just not happening. If you're buying a property with under market rents, of course, it all comes down to what you're buying it for and what the seller is willing to let go of the property for. But what we're seeing for the most part everywhere is that sellers got used to higher sale prices over the past few years, and their expectations haven't come down enough to account for the fact that rates are close to double what they were 18 months ago. So it's what to expect. I would say it's really, if you go in and you buy a loan or buy a property where the rents are $700 and you think market is 1,200, then it's unlikely you're going to be able to cash flow a stabilized loan, at least in the amount that you want. So you might expect 55, 65, 70% LTV on something like that, whereas in years past, you could almost guarantee 75 to 80% if you had a good lender and a good underwriter.
Cool, man. All right. Well, Mr. David, I got to be mindful of your time. We're going to transition to our final question, and then we're going to get listeners some form of contacting you to get a deal done with you, my man. So let's do it. Here we go. Let's imagine it was 100 years from now. You have great grandchildren. They're super happy, and they want to write a book about you to honor you in your life. What would you want them to title this book? Or what characteristical traits would you want them to highlight about you?
Okay, that is a good question. 100 years from now, I need to have some heirs at that point. But I think I would say something, the first thing that comes to mind is probably something titled maybe The Power of Delayed Gratification or something like that. I think there are a lot of people in our circles that can probably speak to this as well, but there's kind of there's a power and an element of success or level of success that people often find when they've been able to push off the more immediate gratification and keeping up with the Joneses. And I feel that I would be no exception to that. And I would think that that would be an appropriate book to write 100 years from now. We'll see. I'm still on that path, but we'll see.
Oh, you're crushing it, man. And just to back that up, I mean, we've been talking now for almost 3 years, and I haven't been able to do a deal with you yet. It doesn't mean that we're not going to, but you still provide me guidance no matter what. And that is really important to me as a buyer. And I truly appreciate it, man.
Yeah, for sure. That's what it's all about. I mean,
Awesome.
my favorite part about this business is the relationships that I've built, and that obviously includes you and everyone else that I've connected with. So it's you might go a couple of years without doing a deal, and then you're going to get a few, and then we're going to have a few that are going to come to me, and then there might be some that have to go to a bank or another kind of creative lender in some fashion, and that's okay. That's all part of it.
Cool, man. Well, it's been a true honor and pleasure talking with you today, David. I learned a ton, and I know that people are going to want to speak with you more. So, how can they reach out to you?
Yeah, email is probably the best way just to catch me and stick around in my inbox. I'm on the phone a lot, so I do tend to miss quite a few phone calls. I'll always call you back, but you can get me via email, david.fraz@lument.com. And my last name is spelled Frasz, and Lument is LUM as in Mary, EN as in Nancy, T. And so david.fraz@lument.com, and that'll get you right to me. And I'm pretty active with that. So generally I'll be able to respond within 24 hours or even sooner. So, and then you'll have my full contact information. We'll be able to go from there.
Awesome. Well, like I said, David, I learned a ton from you today, and I'm really happy that we got to connect. Let's continue chatting, and thank you, my man.
For sure. Appreciate you having me on.
Hey, Small Axe community. I would like to say thank you for listening to another episode of this podcast where we show you how to use your small axe to build a lasting empire. Now, if you like what you heard, it would mean the world to me if you could leave me a 5-star rating and write a written review. Hey, let's take it one step further and share this podcast with someone that you feel could benefit from it. And until the next episode, keep sharpening those axes.